You've probably heard it 100 times before. Delay Social Security as long as possible for the higher lifetime benefits. But what if that cookie cutter advice actually increases your risk of running out of money? The numbers I'm going to show you may surprise you because even if you have a sizable nest egg, drawing from your IRA first can backfire even if retirement conditions are perfect. So in this video, I'm going to walk you through how taking Social Security early might actually protect your nest egg and when it makes sense to delay. So we'll break down what delaying really gives you, what you risk by waiting, and why context matters more than rules of thumb. You can stop guessing yourself and finally feel confident in making the best decision for your retirement. Let's start with something we have to get crystal clear on. Delaying Social Security gives you more money. But what does more really mean? And why does it matter beyond just your lifetime? See, most people say I'm delaying until 70 to get the 8% bump. And that's true. For every year you wait past your full retirement age, usually 66 or 67, your benefit increases by 8%. But that increase stops at 70. So if your benefit at full retirement age is $3,000 a month, delaying to 70 would increase it to around $3,960 per month. So that's nearly $1,000 more per month every month for the rest of your life. And that's not a small number, but it doesn't exist in a vacuum. Here's the part most people overlook. Those higher benefits don't just help you, they help your spouse too. If you're the higher earner and you pass away first, your spouse is entitled to your full benefit as a survivor. And that survivor benefit replaces their own, even if it's smaller. So by delaying, you're not just increasing your income, you're potentially increasing theirs down the road. But we can't ignore the other side of the equation. If you delay and pass away early, those benefits never get fully realized. You spent down your portfolio to delay a benefit you never lived long enough to enjoy. And here's another wrinkle. The survivor benefit only applies to one spouse. So if both spouses pass away early, the benefit is gone. The Social Security system doesn't refund you for what you didn't collect. And that's why it's so critical to look at this decision through the lens of your actual health, family history, and long-term goals, not just the promise of a higher number. And to make this real, let's look at a real couple you might relate to. So they've saved diligently and now face one of the most important decisions of their retirement. Now, I've changed their numbers and their names for confidentiality. John and Heather are both 60 years old and recently retired. So they live here in California and have a combined IRA balance of $2.7 million. John's full retirement age benefit is $2,800 per month and Heather's is $2,500 per month. Their after-tax spending goal is $12,000 per month, which includes everything from groceries and travel to giving and early retirement healthcare premiums. Now, the question they're asking themselves is, we don't need Social Security yet, so maybe we should delay. That's the question they're grappling with. Should they draw from their IRA now to cover expenses and delay Social Security until 70 for the bigger checks? Or should they take benefits early at 62 and preserve more of their portfolio? But let's look at the actual numbers. Because they're age 60, if they wait until 70, that's 10 years of creating income exclusively from the IRA accounts. So to cover expenses, they'd need to withdraw somewhere around 6.4% from their IRA in year one and keep pulling at a similar level for the next 10 years. This is a compounding issue since those early withdrawals from the IRA create a smaller base to grow from. And over a long retirement, that can cost them hundreds of thousands of dollars. Now, if they both take benefits at 62, it's only 2 years away from receiving Social Security income, and the stress on the portfolio is much less once they begin. But taking early benefits also comes with a cost. They're locking in smaller checks for life, and if either spouse lives a long time, they may wish they had the bigger checks. This is where context matters. What are your goals? What's your health outlook? And how much market risk are you comfortable with? And it's not just a financial calculation. There's also the emotional side. See, because you may feel better having some guaranteed income early on. Starting Social Security can reduce the anxiety of fully relying on investments. That sense of security matters in the real world, not just a spreadsheet. Yet, you still might be confused because everyone says delaying pays off, but that assumes one very important thing: living a long life. What if that's not your reality? We all know the person who died way too early in retirement and never got to use the benefits they paid into. This is where break-even math comes into play. See, if John and Heather take benefits at 70, their break-even age, so that's the age where total delayed benefits finally catch up to early benefits, it's around age 80. Now, if you live into your 90s, delaying may come out ahead. But if something unexpected happens, you may leave a lot on the table, especially if both spouses pass early. We can't predict lifespan with precision, but we can weigh probabilities and lean towards flexibility. And starting early doesn't mean, you're giving up. It means you're protecting against one very real risk, which is dying before waiting paid off. And this is why personalized modeling matters. In John and Heather's case, we can clearly see that if they both live past age 80, delaying pays off. But if they don't, claiming early gives them more cumulative income. This isn't just about betting on only longevity. It's about acknowledging that not living long is also a risk worth preparing for. But even if you plan to live a long time, the markets won't always cooperate. And here's the question I think most Social Security analysis misses. Could the year you retire make a bigger difference than when you claim benefits? So for example, if you retired right after a market drop, suddenly withdrawing from your IRA feels a lot riskier. This is where sequence of return risk matters. If you retire in a down market, delaying Social Security forces you to rely more heavily on your investment accounts. That increases the portfolio withdrawals when asset values are already down, which can compound losses and shorten how long your portfolio lasts. So to see this in action, let's say John and Heather retire before a year like 2008. Their IRA has dropped significantly, but they still need $12,000 a month net. If they delay benefits, they're pulling that entire amount from a depressed portfolio. But if they start Social Security at 62, they are less reliant on their IRA in the early years. And this makes a huge difference. That reduced withdrawal buys time for the portfolio to recover. So as we can see here, taking benefits at 62 was about $890,000 better than taking it at 70. Now, what if they retire into a bull market? Because you might assume that's the perfect time to delay Social Security because the portfolio is strong. But here's the surprising part. Even in strong market years, early claiming can still leave you with more at the end. So as we can see here, taking benefits at 62 was about $850,000 better than at 70. So why is 62 still better? Because not pulling as much from the portfolio early on allows for more compounding. The smaller the draw in the early years, the more power you give to long-term growth, and that effect compounds over decades. Now, the idea isn't to perfectly time the markets, it's to reduce the sequence risk by minimizing withdrawals in the most vulnerable years. That early flexibility can create a lasting stability, but let's dig into why taking benefits at 62 can create such a difference in portfolio balances, even when long-term returns seem pretty reasonable. Perhaps you were expecting the difference in claiming age to be different, but you weren't expecting around an $800,000 difference in both good and bad markets. Now you might wonder, well, what if we assume lower returns? Because this is a valid concern. If we were using overly optimistic return assumptions like 12% annually, that could skew the analysis. But in our modeling, we use what we believe are conservative forward-looking estimates. A 75-25 stock bond portfolio in today's environment might reasonably project a 7% real return over the long run. And to stress test those assumptions, we use a regime-based Monte Carlo modeling system. That means we model worse outcomes in the early years of retirement, so like lower returns, higher inflation, before shifting back to more historical norms. This is not a cherry-pick simulation. It reflects the kinds of market conditions many of you might realistically face. So even under stress-tested conditions, taking benefits at 62 still shows a portfolio advantage. Because the core mechanics of reducing withdrawals and letting the remaining balance grow don't change. They just become more important in a low return world. But let's not forget taxes either, because smaller withdrawals early on may reduce taxable income, which adds another layer of benefit. Not always, but often. But we must remember that John and Heather live in California, which doesn't tax Social Security. So by taking at 62, they are able to create a base level of income not subject to California's high state taxes. So no, the analysis isn't skewed. It's grounded in realism and designed to ask the right questions, not blanket claims. Early claiming isn't always better, but the mechanics of portfolio math deserve more attention than it usually gets. But what if you're less focused on the portfolio balance and more focused on the long-term tax efficiency or legacy? And here's where delaying can shine. We work with lots of families that want to make sure they are financially secure first, but then want to look at helping their children steward the family wealth and minimize taxes when they inherit. See, delaying Social Security opens a tax planning window. When you don't have Social Security income showing up on your tax return, your taxable income can drop, sometimes significantly. That gives you the space to do strategic Roth conversions at lower rates and often below key IRMA brackets. In John and Heather's case, delaying to 70 allows them to convert IRA dollars each year to Roth accounts while keeping their income below the first Medicare premium surcharge threshold. That not only reduces their future required minimum distributions, but also moves assets into the tax-free vehicle, the Roth IRA, that their heirs can benefit from. And as you'll see here, the numbers are powerful. Under this strategy, their lifetime tax bill drops by around $900,000, and their projected net legacy value, which is the tax-efficient amount they can pass to heirs, increases by around $150,000, right? These are meaningful numbers. It's not just about the tax bill, it's about the flexibility. A Roth account has no RMDs. It allows more control over your income in retirement. And when your beneficiaries inherit, they can get up to 10 years of tax-free growth before needing to withdraw all of it. So if your goals include tax minimization and legacy planning, delaying Social Security can be a tactical advantage. You're not just getting higher checks, you're creating more room to execute tax-saving strategies. But that said, this doesn't happen automatically. You need a coordinated plan. You need to know how much to convert, when, how it fits in with your Medicare and ACA planning. That's where professional guidance can often deliver multiples of value. But just because you take benefits early doesn't mean you lose every tax advantage either. But you do need to be more strategic. I often have people ask, if we started Social Security at 62, can we still do Roth conversions? And the short answer is yes, you can. You just have less room to work with because Social Security benefits are taxable above certain income thresholds, and starting benefits adds more income to your tax return. So sometimes that compresses the space between your current income and the next tax bracket, but that doesn't mean Roth conversions are off the table. You can still convert up to the IRMA threshold without triggering higher Medicare premiums for John and Heather's case. See, for John and Heather, starting Social Security at 62 reduces their tax planning flexibility. Their total lifetime tax savings from Roth conversions drops from about $900,000 to about $870,000, but they take a hit to their net legacy. So some people may not care about that, but John and Heather did, yet it wasn't enough to sway their decision. The key takeaway here is early claiming doesn't kill your tax strategy, it just kind of narrows your runway. And if the emotional or market-based reasons for starting early feels compelling to you, this trade-off might still be worth it. The important thing is knowing what you're giving up and what you're keeping. That way your decision is grounded in strategy, not just guesswork. And as you can see, financial models are helpful, but retirement isn't just about math. How you feel matters too. See, lots of people gain peace once they start Social Security, often because they aren't 100% reliant on their portfolio to create income. And for many, the emotional side of starting Social Security early is hard to quantify, but very real. It creates a sense of forward motion. It feels like a reward for decades of hard work, and it eases the mental burden of drawing down your portfolio. This matters most during market downturns. When the market drops 20% and you're relying entirely on your investments, it can trigger stress and panic. But if you're getting a $3,000 check from Social Security every month, that in some ways softens the blow. It gives you room to think and act more clearly. See, financial models like this will show trade-offs, but they often miss the emotional reality of retirement, and peace of mind deserves a real seat at the table in this decision. You just saw how the timing of Social Security can dramatically impact your portfolio balance, sometimes by hundreds of thousands of dollars. But what if the real question isn't when to claim, but how your total portfolio balance changes your retirement entirely? In this next video, I'll show you the surprising differences and surprising similarities between retiring with $2.5 million versus $5 million and what truly changes once you cross that threshold. I'll see you over in that video right now.